Hello Knights, welcome back to another video here where we're going to talk about some breaking news that came out today. The retail sales. So the retail sales data was released today and we saw that retail sales declined 0.3%. So that's what you see here on the screen. Advanced retail sales September, negative 3%. And the reason I want to talk about this is I've seen, first off, some people were alarmed by it, and I think the first thing you should easily notice here is that retail sales declining isn't the end of the world here. So, so I can't expand this back to the actual recession where we see a dramatic decline in retail sales every single month. And so, as you can see today, we're definitely not there. We're just sort of wiggling and wobbling back and forth. And so, this alone doesn't to me, it doesn't raise any signs of a recession. Annually, retail sales are still up 2.4%. That's a solid number in terms of that will trickle into GDP. Now, it is weaker than previous periods, but that shouldn't surprise anyone. And so, going along with this, with the retail sales, I saw some people writing about and talking about, well, this gives the Fed more reason to cut rates this month. They'll be meeting in a couple of weeks to decide if they want to cut rates again or not. And interestingly, this is the first meeting in a while where we don't have a consensus among investors and economists about what the Fed will do. It's something like, I believe it's 78% are expecting a rate cut. And so, and like I said, this is the first meeting in a while where we don't have a 100% consensus among economists. And so, we'll see what happens. But some of the things I want to talk about was, what happens after a rate cut. I think that fairly recently the president definitely seems to believe that rate cuts mean the stock market goes higher, and that doesn't make any sense. I think that President Trump needs to definitely read more about what rate cuts mean. Now, that being said, so let me explain how that works. And so typically, and to understand how that works, we got to first look, okay, how are stocks valued? And so typically stocks are valued by by forecasting out cash flows and then discounting those cash flows back to the present. And so when those earnings growth rates and those cash flow growth rates increase, then the value of stocks go up. When the cash flows and earnings growth rates decrease, the value of stocks comes down. And so that's typically, and baked into that are interest rates. And so this is where you get sort of people thinking, okay, the interest rates are the main determinant of stock price. But that's just not true. And so let's explain why. So as I just said, so let's go back now to interest rates. So when the Fed lowers interest rates, that is essentially the discount rate used to calculate the present value of the stock prices. And so when the interest rate declines, the value of stocks go up. So that in itself, holding all else equal, if you lower interest rates, that value of stocks will jump up by whatever that interest rate decrease is. But here's the issue. If you have interest rates declining, that's also a signal to investors that the economy might be slowing down. And so if investors have expectations that earnings growth rates and cash flow growth rates will decline, then that throws off this whole picture. So you can think of it as you have two forces. On the one hand, you have interest rates are causing stock values to go up. On the other hand, you have lower earnings growth rates causing stock prices to go down. And so it's a balance. Which one has more weight? Which one has more weight? And that will determine the direction that stock prices go. And so that's why just lowering rates, as the president wants, does not necessarily mean by any stretch of the imagination that stock prices will go higher. And so that's sort of the bigger picture here. And so that's how the stocks work and how interest rates affect stock prices. And so let's talk about an even bigger picture from an economic perspective. First let's go back. The Fed's job, they have a dual mandate. Congress gave them this dual mandate when they created the Fed of stable inflation and maximum employment. Both are vague. No one really knows what maximum employment is. Some used to think it was 4.5%, 5% unemployment rate. We're well below that, and there's still a little bit of slack, although that slack is deteriorating. And so, but for all intents and purposes, we're probably at maximum employment today. And you can see that in the wage inflation. You're seeing wage inflation has really picked up the last probably year and a half. And so that the other mandate is stable inflation. Again, very vague. What is stable inflation? Economists tend to view stable inflation as about 2%, a target of 2%, because we view deflation as very bad, and it is. So you have deflation is very bad, and so we want to stay away from 0%. And also, obviously, hyperinflation can also be bad. And so we try to target around that 2% goal. And so here's the issue. If we're raising rates, if we're lowering rates today to keep the economy going, to avoid a recession, we're increasing the possibility that we have a spike in inflation. And so I have here, as I said, wage inflation has been picking up, almost 4% a few months ago, and still over 3.5%. And so wage inflation does trickle into regular inflation. There is a lag. There's an argument over how long that lag is, but typically you're looking at 9 months or so. And so eventually this wage inflation will trickle into that into our regular CPI, or consumer price index inflation. And when that happens, if the Fed's lowered rates and so here's sort of the big picture. If the Fed's lowered rates to stabilize the economy, and then inflation spikes, they're going to have to raise rates going into a recession. And that's where you get things like stagflation, where you have high inflation and low output or low GDP. And so I think that we're at a delicate time here, where here's the inflation data, where inflation's been pretty subdued. We haven't continuously been over 2% for a long time, and so that's good. So that's obviously good for prices, but eventually you should start seeing this pick up, especially when you consider how much fiscal stimulus we had and monetary stimulus we had. And so I've always been and so I think that if you're just looking at employment and inflation, there's no reason to be lowering rates today. There just isn't. You could say, well, we're trying to make a soft landing, what's called a soft landing into the recession, where the economy is going to come down instead of a hard crash. You can manipulate it to be a soft landing into a recession, and there's benefits, and there's very good benefits of that. But that still ignores the fact that you're in a recession with your rates already as low as they can go. So there's no real way for monetary policy to now stimulate the economy in the recession, and you have a risk of high inflation. Because as I showed you have wage inflation picking up. This trend should continue higher. especially because we've lowered rates a couple times this year, and we're probably going to do it at least one more time this year. It's probably happened this month. Um, and I think that another thing to consider is the trade war. So as I said, we're trying to negotiate a soft landing on the economy, expecting this trade war to last a long time. I don't think it's going to last forever. I think with the election coming up, Trump's going to have to back down from this trade war because he's making a lot of people angry, particularly farmers, but also manufacturers. And so he's going to have to back down before the election at some point. Cut a deal, whether it's a good deal or bad, he's going to have to do something. I guess, and so that's how I see it. And so getting back to retail sales, today's negative 0.3% retail sales number. I don't think it changed any picture, just because we see retail sales, they always fluctuate. It's just how it goes. I mean, because this is a monthly figure, so if you have high sales one month, you're gonna have lower sales the next month. It's hard to keep going higher and higher when it's a monthly growth rate. Now that being said, we're gonna have to see what happens next month, because as you can see, the last recession just you have June June is 0.1, then negative 0.4, then negative 0.7, and it just keeps collapsing. And so obviously we're hoping to avoid a repeat of 2008. And I'm not trying to scare anyone. We're not going to be anywhere close to that, barring any hidden crises that are being hidden by banks or the government. And so I don't think that this retail sales number will change the Fed's mind on whatever they're going to do later this month. I think that they will lower rates or keep rates the same regardless of this. And I would say I probably would go with the majority that they will cut rates again, just because we have seen other data showing that the economy is slowing down, and I think that that's probably what they will do, because this Fed seems to be focused more on output rather than their mandate of inflation and unemployment. And so, we'll see how that turns out. The last time we did that, we had stagflation, so hopefully it doesn't happen again, but we'll find out. And so if you have any questions about any of these topics, shoot me a comment, subscribe. I'll make a video answering any questions, concerns you may have. And so as always, like I say, comment, subscribe, like, and the night is signing off.